Hi everyone, welcome to episode 3 of Fridays with FEMA. This is Ashish and I lead the regulatory and tax practice at Parakram.
Hi, this is Janisha. I lead the corporate and regulatory practice at Parakram.
Today we are discussing the very interesting topic of overseas investment laws. And we'll be discussing this for the next couple of episodes to cover as much as we can on this. This is very relevant for people who want to make investments abroad. So over to you, Janisha, on what you would like to talk about overseas investment laws today.
Yeah, I think before we get into what is overseas investment, let's just give a broad overview in terms of what are the laws dealing with this. On one hand, you have the overseas investment rules, which essentially talks about investment into the share capital of an offshore company. And on the other hand, you have the overseas investment regulations governed by the RBI, which talks about investment into the debt instruments of an offshore entity and along with other reporting and compliance requirements. We also have a master direction issued by the RBI, which helps clarify matters under both the rules as well as the regulations and helps in the implementation of the Act. So, with this as the regulatory background, Ashish, do you want to throw some light as to what is the definition or understanding of ODI and OPI?
Sure. So ODI, which is the overseas direct investment, let's divide that into two quick parts, right? One
Yeah.
is the unlisted and the listed. On the unlisted front, if you're acquiring any shares of a foreign company or subscribing to the memorandum of a foreign company, it would fall within the meaning of ODI.
Right.
And on the listed front, if you are buying more than 10% shares of a foreign listed company or less than 10%, but with control in the foreign listed entity, you would automatically fall within the meaning of ODI. Anything that is not within ODI is automatically covered under OPI. So that's the basic meaning and understanding of ODI and OPI.
Sure. So, conceptually, if my investment is in ODI or OPI, how does it really make a difference to my life?
Uh, from a conceptual perspective, the compliances that are to be made under an ODI are far greater and heavier than
Yeah.
it is in the case of an OPI.
Right. Understood. And that's why this distinction is very important for us to know what compliances are relevant for us. Okay, yeah, makes sense. So I think, Ashish, you mentioned a couple of things when you were explaining the concept of ODI, right? One is the concept of investment or acquisition of equity shares of the foreign entity, right? And you also use the word control. So let's go through each of these terms one by one.
Sure.
What do you mean by the equity share capital of a foreign entity?
Right. So equity shares, as the name calls out itself, right? It's the equity shares of the foreign company, or as a definition under the OI laws provide for it, is basically irredeemable or non-debt capital of the foreign company, which is compulsorily and fully convertible into equity shares. So the underlying point here is that if you are making an ODI, then it needs to be into an instrument which will fully and compulsory convert into equity shares or equity shares itself. That's the underlying point that you should be mindful about.
Interesting. So, um, as you may know, I think in one of our cases, we were also having trouble routing an investment into a warrant structure, which was to be issued by an offshore entity, right? So, I think the idea there was that if your warrant, the terms of your warrant are such that it is going to be compulsory convertible into equity, you need to really explain that, and only then you're going to be able to route through this investment. Otherwise, investment through a warrant structure can be very tricky practically, considering the definition of the equity share capital. Yeah. And okay, so we need to, so investment into equity shares, which you've explained, into of a foreign entity. So let's discuss the concept of a foreign entity out here.
Sure. So now foreign entity is basically under the OI laws is an entity which has in which your investment is there is a limited liability on your investment.
Yeah.
So if in the Indian context, if you have a limited company or a limited liability partnership, that's where your liability is limited and will be considered to be a limited liability entity. Similarly, it would be for the context in the context of foreign entity as well.
Right. So I think a classic example is an LLC, a very common
Yeah.
vehicle which people invest in. If they're investing, in the US, etc. So I think that's an example of a limited liability corporation in which or a foreign entity in which you can do your ODI investment.
Yeah, absolutely. I think the term LLC itself states it's a limited
Exactly.
liability corporation,
Exactly.
right?
So yeah,
So
it should.
Yeah, so
fulfill the requirement of a foreign entity.
absolutely. And the instruments,
Right.
like I already mentioned, should be such that they are compulsorily convertible into equity
Correct.
shares. And
Correct.
therefore, if those conditions are met, then you can definitely invest into
Correct.
an LLC
Correct.
as well.
Correct. So while an LLC does issue units and not strictly share capital, however, because of the whole limited liability construct, I think in the past as well, we've been able to route or do ODI investments into an LLC, and that's been forthcoming. Okay, I think this is important, and I think very quickly moving on to the definition of control, right? What do we mean by control? Because that's relevant if in case of a listed entity where I am holding less than 10%, but I may have control over the listed entity, and then my investment would be considered as a ODI. So there is some element of subjectivity here. So yeah, what would
Absolutely.
control mean?
So control again has been defined as, the power to appoint majority of the directors, or to have, or when there is control over the management or policy decisions,
Hmm.
this would constitute control. And if you are holding more than 10% shares of the foreign company, then
Right.
that is it is deemed that you have control in the foreign entity, and you would therefore fall
Right.
within the various definitions.
Right. So I just want our viewers to make note of this point that more than 10% amounts to control, and that's going to be very relevant in our next subsequent episodes when we discuss the concept of subsidiaries, etc. But Ashish, I think the coming back to how this qualifies an ODI and how this is used in the context of ODI, I think this definition of control is very similar to how we've seen control being defined in other laws in
That's
India,
right.
like even the Companies Act, and definitely has a subjective element. So one needs to see whether what really amounts to day to
Control.
having control over the day-to-day management and policies of the offshore entity, and that could be by virtue of your shareholder rights, even though your investments are below 10%. So that's a subjective test which needs to be evaluated carefully in a listed company context, and that would determine whether it's an ODI or not.
Okay. Absolutely.
Okay, I think with this as the background, let's dive deeper into the discussion on OI laws. So, yeah, a quick recap, right? The current ODI regime replaces the erstwhile ODI regime since August 2022. However, a lot of overhang, a lot of things done in the previous regime continues to be relevant to our practice or to things that we want to do even today under the new law. I think one such thing is the whole concept of gifting of shares of an offshore entity under the previous regime, which today has been made very stringent, and you need FCRA approval, etc. But Ashish, you want to throw some light firstly in terms of what was the gift structure under the previous regime?
Sure. So, what used to happen was that, friends or relatives of an Indian individual used to set up a foreign company with offshore money, and then gift the shares of that foreign company to the Indian resident individual. Now, why was this done? Normally, this was done because the foreign entity which was set up would actually first set up a subsidiary in India, and then the non-resident would give the shares of the foreign company to the Indian resident. So
Like a very common structure to set up your flip structures. Yeah.
absolutely, very common structure to set up the flip structures where you want to externalize your business outside India, right? Now, why was this particularly done? Because this structure where an Indian resident is holding shares of a foreign company, and that foreign company has an Indian subsidiary, is technically considered to be as round tripping, which was frowned upon by Reserve
Yeah.
Bank, and therefore
Yeah.
to circumvent this direct sending money outside and then bringing it back into India, these structures
Commonly
yeah,
used.
were commonly used.
Right. I think just to clarify that round tripping was never defined under the previous law. There was an FAQ on the same, which threw some light. But the idea was that because the shares are being gifted, it's not an investment made by a person resident in India outside India, and hence there should not be a round tripping concern. And hence this gift route was used as an alternative to ensure that there are no round tripping concerns. Okay, so that's what was done in the previous regime, and I think a lot of those structures were undetected because there were really no reporting requirements
That's right.
in the gift structure. Why?
Unlike in an
Yeah,
ODI situation where
yeah,
you would get a UIN number, that's the unique identification number, In case of a gift structure, when the non-resident gives the shares to the Indian resident, there is no
Yeah.
reporting required, and therefore this UIN would never be generated.
Yeah, exactly. And while, as I mentioned, this has been tightly regulated today. It's not that one can freely just give shares of an offshore company to an Indian party today. It requires FCRA approval as well. However, what's interesting is whatever was done under the previous law, the new law clarifies that if you've done something as per the previous law, it is protected and saved, and it would be assumed that you've done it in compliance with the new law. So if whoever I mean, people who've legitimately availed of the gift structure route under the previous law, technically that should be saved, and should not have any issues, even in light of the new law. However, today, if somebody who's acquired shares under the gift route wants to sell the shares of the offshore company, right, you will have to make reporting requirements. You will have to report the sale under the new law, by way of doing filings in Form FC, etc., with your AD bank. And that's where a lot of practical challenges come in, because every reporting is backed by a UIN generation and the previous reportings you would have made, which would be fully absent in this particular situation, right?
No, absolutely. I think, see, if you look at the language that has been written under
Right,
X6, right, it says that everything that has been done in the earlier regime will be as if it has been done in the current regime.
correct.
Now, if you read that language very strictly, it means that a gift structure should technically be reported in the current regime, and we should have, a UIN or the FCRA approval and all of that, right? But practically that is not happening, and
Hmm.
therefore, if you want to make a sale of your gift structure, then it could pose some
Yeah,
challenges.
it could pose some challenges,
Yeah, and
correct.
at this point, Denisha, I'd also like to point out one of the cases where we were discussing with one of the clients that they wanted to send money abroad,
Hmm.
and the structure was such that there was a foreign entity which had an Indian subsidiary. The structure was, yes, of course, set up under the gift structure,
Under the
uh,
old
under the
regime.
old regime, yes.
Yeah.
And when they wanted to remit the money at that point in time, the bank actually told us that RBI is actually looking at this structure quite closely, and has some questions around that. Uh,
Hmm.
Fortunately, the bank was able to satisfy RBI with all the questions, but
The
the
bona
bank,
fides of the
yeah, the
structure.
bonus structure,
Yeah.
absolutely. But
Right.
the undertaking that the bank took from us was that you are not going to set up any third subsidiary uh, 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 of the foreign entity in India, basis which they were able to make the
Interesting.
remittance. Yeah.
Interesting. So, bottom line, that the gift structure under the previous regime, though it was perfectly allowed, it is not free from scrutiny under the new law, considering you have reportings under the new law. The gift structure has been now tightly regulated, and there might be questions raised. And I think what's essential is to establish the bona fides of the structure and of the transaction. So I think that's going to be an interesting space to continue to follow.
Yeah, absolutely. Another example, since we are talking about this, is basically in the earlier regime, what used to happen was that if you were making investments of less than 10%, less than 5%, and this totally dependent on bank, you could be considered to be an OPI investment,
Yeah,
an overseas
yeah.
portfolio investment, where again, there was no reporting that was done as
Mm.
such, and you were able to just get shares of the foreign company. Now, because there was no reporting, there was no UIN generated, and this was done very often by various AD bankers, where the money was sent out and shares were issued. But now, if you look at this in the current context, and if somebody has shares of a foreign company in the
Yeah.
earlier regime, which they have actually bought under the LRS slash ODI regime of the erstwhile,
Previous,
yeah, erstwhile
yeah.
regime, how would they be able to make a sale of that
Yeah.
today, right?
Yeah, that's
Uh,
also where they're going to ask today. Selling those shares under the erstwhile portfolio investment regime is going to require, again, questions of UIN, etc., when you're going to report it today. And I think practically we've managed those where we explained that this was under the previous
yeah.
regime where a UIN was not required. So, on the strength of Rule 6 of the OI laws, which saves the transactions are done under the previous law, you need not, you don't need to ask me for the UIN generation, and we need to accordingly proceed
Yeah,
with the
absolutely.
filings. Yeah.
Yeah, and these could be significant practical challenges, because if
Yeah.
you look at Form FC today, there is a one of the sections provides for the sale of the shares,
Yeah. Yeah.
and over there the first thing you need to fill up is the UIN
UIN,
number, and
absolutely.
what would you fill in there when you make a transaction like this? But yeah, I mean, that's, I think, the beauty of the whole
Well,
regulation.
yeah,
And
OI
yeah,
laws.
and yeah, absolutely.
I think, especially because you spoke about practical challenges, considering every bank may have its own interpretation, thinking, its own practices. With some regulatory teams in the banks being comfortable, not comfortable, that further adds on to the practical challenges in actually reporting this transaction, where previously a UIN or reporting was not required. So yeah, I think that's an interesting take. So I think with that, Ashish,
Yeah, so I think just one
yeah,
additional thing is, I think we spoke about what is equity share capital, etc.
hmm,
But I think maybe you want to also tell everybody who can do ODI from India, right?
yeah,
And because that will become relevant for our
yeah,
next sessions and how
yeah.
we are going to tackle all of that.
Yeah. So I think, just very quickly talking about who can invest under the ODI regime, of course, with a number of conditions and restrictions which we will be discussing as we go ahead. You have individuals, persons resident in India who are individuals who can undertake ODI. You have body corporates, liability companies, limited liability partnerships, and even general partnerships registered under the Partnership Act 1932 who can undertake ODI. In subject again to certain terms and conditions, you also have EIFs and registered societies, trusts who are able to undertake ODI. So these are the qualifying persons who are eligible to undertake ODI, but of course, with compliances of varying degree for each of them, which we will discuss in, I think, the next couple of episodes. Yeah, I think with that, Ashish, I think we can close this one, and see you all soon for episode two with respect to our next episode, where we are going to continue to discuss this topic in further detail.
Perfect. Thank you so
Thank you so
much. Thank you for
much.
joining.